What's been, on your perspective and on your position as the economist, fundamentally happened to Indonesia lately that we have this triple combo attack, or so-called?
We carry out a cross-country analysis every quarter for Asia, and we call that analysis the analysis of external funding. That for every single economy in Asia, how much is your current account funding needs for a given year, as well as how much foreign currency loan do you need to refinance both government and corporate loans. So when you put it together, you get the whole year's funding needs. And the way we look at a country's ability to handle this sort of funding is we scale it against the reserves. So of course, Indonesia has some funding needs for 2021, and Indonesia has a stock of foreign exchange reserves, which is much more than it was in 2013. But the problem is that the liabilities themselves have also gone up. So the ratio, which is that external liability to reserve, has not improved significantly compared to 2013. So when you look across Asia, in 2013, during the taper tantrum, there were 3 countries whose currency came under a lot of pressure. And the triple threat that you talk about, the yield of the bonds went up, currency became volatile, and the equity markets saw correction. There were 3 countries in Asia that really faced that pressure at that time: Indonesia, Malaysia, and India. Now, come to 2021, 8 years later, again, is it the case that those 3 countries are most vulnerable because their buffers on a relative basis are the lowest in Asia? Well, one country is not in that group anymore, and that is India. India, over the last 8 years, has gone from a reserve position of about $250 billion to over $600 billion. And as a result, that external liability to reserve ratio for India has improved substantially. So now when foreign investors look across Asia and consider countries where funding could be an issue if indeed interest rates go up, dollar liquidity tightens, they would only look at 2 countries: Indonesia and Malaysia. So Indonesian ringgit and Malaysian ringgit and Indonesian rupiah would be the 2 currencies in our cross-country analysis that could be somewhat vulnerable. So it's all relative. Fundamentally, Indonesia is much stronger than before, but on a relative basis, some other countries' fundamentals are even better than Indonesia's.
Oh, good news from you, Taimur Baig. But again, I've been so wondering about this because you keep mentioning about the tapering tantrum, and remind us again about the tapering tantrum has been done before or has ever happened before. In case, when we talk about the possibility of taper tantrum in 2021, what the narration would be, the risk factor if, in case, again, taper tantrum happens in 2020, the readiness of all of us, especially in the emerging market.
We have learned from the past what works and what does not work. Hiking interest rates does not really work. It creates more negative impact in the market. Capital does not come in just because you're hiking rates. People start wondering about the growth outlook. People start wondering about debt sustainability of companies which will not be able to handle higher interest rates. So I think that prescription that used to be given by the IMFs of the world in the past, that if you see capital flow volatility, go hike interest rates, I think that is off the table. I would not expect Bank Indonesia, even if it faces significant outflow pressure, to carry out monetary tightening. So put that aside. What are the things central banks can do if there is indeed significant pressure on the external account? Well, they can carry out macroprudential measures. So, for example, they can see if they can address weakness in, say, the property market or some parts of the lending market. They can tighten those areas to reduce some degree of liquidity creation. They could also seek ways to issue external bond through very safe routes that is underwritten by a multilateral agency, or maybe some green bond which has particular demand. So those ways, you don't necessarily have to pay very high interest rate that the market is demanding, but at the same time, you're shoring up your external finance. You can tap into bilateral credit lines, which I think is the biggest innovation for sovereign stability over the last 10, 15 years since the global financial crisis. So Bank Indonesia has a bunch of dollar swap lines. So if need be, they can shore up liquidity in those ways as well. So typical response to capital flow volatility is hiking rates. I don't think that is on the table, but there are a wider range of tools available, including coming up with safer ways of raising external currency debt and also cooling down some part of the domestic economy to reduce money creation or liquidity injection. So those kind of things, I think, would be the way to prepare for a possible taper tantrum part 2.